this very special episode on Outlook Money, where we help you plan your investment choices a little better, or at least we give you the pros and cons so that you can make a smart choice. I'm Ridhima Bhatnagar, and today we will be looking into the fascinating world of debt funds and long duration funds. And for that, I have a very special guest with me. We have Mr. Shrinivas Khanolkar joining us, who's the head products, marketing, and corporate communication at Mirai Asset Investment Managers India, joining us, who's been kind enough to take out the time and help us plan our investment better. Srinivas, firstly, thank you so much for taking out the time and joining us here on Outlook Money.
Thank you, Ridhima. It's an interesting topic that we are discussing today and looking forward for an engaging conversation.
Absolutely. The idea is that you make a start of a conversation, right? So that people can have a smarter choice when they try and understand what their investment options should be and how they can diversify their portfolio. But Srinivas, just for like context setting before we really get down to the brass tacks of debt funds and long duration funds, I want to understand the context, the timing, and when we are having this conversation, right? The finance ministry very recently has said that they're cautiously optimistic as far as the economic outlook for the country is concerned. Would you agree with that assessment?
Well, they have much more data points to sort of look at and then give this commentary. But if you look at the past, we have been sort of outlier in the world economy. We have been growing tremendous pace, and by 2027, we're supposed to be expected to be to the third largest economy on this country. And also the layout which has been put forward that we could become the sort of developed market status by 2047, right? So if you have to keep that into mind and at the pace at which we were sort of growing, uh, post-COVID, a lot of things changed, and of course there was acceleration which happened. We are now started to catch up on that because um, the pent-up demand is already sort of consumed, and now it's going to be a reassessment from most people. Even if you look at it, the capex cycle sort of thing has not moved ahead from a private space. Most of them are waiting for the economic conditions to sort of stabilize. Of course, they have, and but global situation sort of kept erupting. Let's be honest, it's been the third year where there has been global conflict somewhere. It started in 22 and then 23, and again we saw a eruption in 24. So when you look at all of that and the domestic sort of cues, we definitely look like there has been the last GDP results, quarterly results have also indicated that there is a little bit of softness. But there are pockets which are doing well, and from interest rate cycles, of course, we have been sort of maintaining a stance over some time and managing fiscal as well as inflationary pressures over a period of time. But we also have to respond to global cues, and I think that's going to be the next phase, which will sort of come into play. And while the ministry and the external experts are looking more into this, we feel there are opportunities now on the debt side where investors should take advantage. And I think today's conversation will help them, first of all, understand how to distinguish debt
Yeah.
with debt, and we'll discuss a bit on that. And also, why always equity may not make sense, and why debt also gives you an opportunity to be part of the portfolio.
Sure. So I think Srinivas, you've set the context really well. So let's really get straight into it. Let's, in a way, split the conversation. Let's talk a little about debt funds and then we can move towards long duration funds. But let me begin with, a conversation that will help amateurs to the experts understand it equally well, right? Every time we talk about a debt fund, the general understanding is that it's either similar or a comparison is drawn to a fixed deposit or an FD. So I want to begin from understanding the idea of debt funds before. Do you think that comparison is fair?
I don't think it is completely unfair, because what happens is when investors are investing, first of all, they're looking at where there could be a coupon which is higher, right?
Sure.
Second, they would look at if I'm taking risk beyond this, then it very well be a multiplier. And if
Hmm.
I am not taking that much risk and it's not giving me that sort of a multiplier return, then my principal should be slightly secure, right? And
Okay.
that's where the comparison between, say, a term deposit, time deposit versus, say, a debt mutual fund comes into play. But before we go there, I think what is happening is investors today, because of this fantastic run that everybody has seen on one side of equities,
Hmm.
are looking at that asset class and then comparing the debt asset class. And I think that's slightly unfair
Okay.
because you should compare, say, the debt mutual funds with the other debt instruments. And I think
Okay.
that's would make life a little easier for everyone to understand.
Okay, so I think you've made a very fair point that you need to see where the comparison is coming from. It can't be apples to oranges, but it needs to be from the same basket, right? If I understand you correctly.
Yeah, absolutely. That's right.
Okay, so debt instruments comparison. The other aspect also is, Srinivas, usually if you look at how they're rationalized or how the tax slabs are, debt funds usually are also seen at a marginal tax slab tax rate. So in that sense, do you think it makes it maybe marginally more favorable or attractive vis-a-vis your traditional instruments?
So there are two parts to it. One, I think with the new tax regime which was introduced,
Correct,
things have become fairly easier for people to understand that what is a long-term asset, what is a short-term asset.
correct.
Right? That's very clear for everyone. So when it comes to, say, equity, I'll give a comparison because it's easier for investors to understand.
Sure.
Anything which is 12 months is short term, and anything which is beyond 12 months is long term. Similarly, in debt, anything which is 24 months or 2 years would be uh, your marginal tax rates, and beyond that would then start falling into for both the asset classes, right? It then starts becoming a 12.5% sort of a regime. So what is interesting here now is that you would be, say, for example, if you're looking at a term deposit, right? You are going to get similar tax treatment to what you're getting to, say, a debt mutual fund.
Correct.
But after that, now you're going to start comparing it from a rate or a return aspect, right? What is the risk you're taking and what is the return it's getting generated? And I think it will be first time we will have a level playing field where the product will be chosen on its merit, right? So a debt mutual fund, the way it is structured and the way it delivers its returns, even historically, if you come and look at the returns, what it would have delivered, it is still better off than your term deposits, right?
Okay.
But there are risks associated with it, and that's something which investors also need to understand. But I'll again reiterate that today it would be easy for an investor to choose the products based on its merit and not on the tax profile.
Okay, so let me just diversify this conversation a little first into just taking it from an investor perspective, right? So when an investor or what kind of investor should be looking at a debt fund, is there a particular risk appetite? Because usually your idea of either diversifying your portfolio or getting an investment is directly proportionate to the kind of risk appetite that you have. And you were just giving us an example of the time horizon as well, right? So if an investor today is looking at a debt fund, what is that kind of investor that should actually be looking at a debt fund today?
So I think one thing is for certain that everybody has a debt in their portfolios. Whether you're holding mutual funds or not is a secondary aspect, but I think everybody holds debt in their portfolio. Similarly, how you hold gold in their portfolios, right?
True.
Some or the other form you're holding gold. Maybe it is not from a investment purpose. You may have bought it from some other purpose, but
Okay.
there is debt in the portfolio, and part of that is also generating some sort of a return.
Okay.
Now, when it comes to debt mutual funds, of course, there are multiple categories to choose from, and each of them would vary in terms of risk profile, time duration, and also in terms of the your appetite in terms of over a longer period of time what it can deliver and over a shorter period of time what it can deliver.
Sure.
And when that is also tagged along with equity, then they become hybrid funds. So
Hmm.
that also has an element. So if any investor is holding a hybrid fund in some way, one third of the asset is also getting invested in the debt, right? Now, let's take, for example, two categories, right? Say a overnight fund and say maybe a short term sort of a short duration product, right? So in an overnight fund, basically you will get invested in a daily security, which yields you a daily return. While if you look at a short duration fund, then you have to invest up to 3 years, 1 to 3 years time duration. So again, the coupon rates for an instrument which is daily maturity, and I think this is easier for investors to understand that if you're investing in something which is going to give you money back tomorrow itself,
Yeah.
I think that that interest rate will always be low.
Yeah.
But if you're going to get something, you're investing in something which is going to get invested with an average maturity of 2 years or 3 years, then of course you're going to get something slightly higher, right? And I think that's how the range starts moving from lowest maturity to the highest maturity. And
Okay.
if investors understand that piece, then it becomes even easier. Let me also give you a sort of an equation for somebody to understand that how it operates. While that example is something which is block by block, I will explain. So, say an equity, right? Uh, its basic thumb rule of equity returns is your long-term inflation average plus your long-term GDP average. If you add that up and plus something extra, say a corporate earnings, right? That would basically be something what an equity would deliver.
Correct.
So, just for an example purpose, if your
Sure.
inflation today is at 5% and your say long-term GDP average is at 6%, so if you add 5 and 6, that's about 11.
11%.
Maybe your corporate earnings or your market sort of because of every corporate will strive to give you something extra or deliver better earnings. Say another 1.5% you add to it. So that's how your 12% number is coming. So anybody
Yeah.
talking about that how is this achieved? Basic maths is this. Now similarly on debt side there is a maths.
Yeah.
What a lot of people sort of it's understandable, but probably we sort of overlook it. You have
Okay.
basically something called risk-free return,
Yeah.
and there will be a risk-free bucket. So if you don't do anything and just give it to, say, someone says, say, put it just on your savings bank account, right? You will get, say, a 4% interest savings interest rate, right? So that's nothing you're doing, but you're getting something. Add that if you sort of add another layer to it, which is time premium.
Yeah.
So that will fetch you another 1.5%. Now today, if you add that up, that will be around 1 year FD rate, right? And then beyond that, you will have something which is say credit premium. Basically, you are lending money to someone and
Okay.
they are investing on your behalf and giving you back some premium.
Yeah.
Right? So now these are the buckets and these are long-term buckets. So whichever says economic cycle you're on, if you just keep adding these numbers, you will realize which cycle you're on and how much you are getting from a return expectation. So for debt, if you just look at risk-free plus time premium,
Yeah.
you would realize that okay, if your risk-free is at 5% and you're getting 1.5% more on time premium, then 6.5%, right? So anything beyond that is something where there's element of risk coming in. And
Yeah.
please, my request would be to all the listeners who are listening to this that this is just thumb rules. It's possible that during certain economic cycles, these rules do
Okay.
not apply, and these are exceptions. But this probably helps you understand when you come to maturities and durations and debt funds that how returns can get generated in different categories.
Sure. So you pretty much actually answered what I was getting to, which is Because there is also, it's not just whether debt fund is the right option for me, which debt fund is also the other option as far as an investor is concerned, right? And today there's a plethora pool of options that are available for an investor. So if I had to ask you three quick parameters that every investor should make a checklist of before entering into a debt fund or getting a debt fund into their portfolio, what would the three parameters be?
One is your risk appetite,
True, which we
right?
discussed earlier.
Right. So
Yeah,
that is one, because you can have a car which goes at 120, but if the speed limit is say 100 or 80, and
correct.
how much can you sort of push yourself?
Yeah,
That is also very important. Right? So
yeah.
one is your risk appetite. Second is, what is your requirement? So if your requirement is that I want more stability, I want more assurity of return, I want to see that I'm not too ahead of in the, say for example, if you're going to equity and getting a
Hmm.
percent return, I don't think you can have the same expectation from a debt fund, because it's
Hmm.
not supposed to deliver in that way. There will be periods where that will happen, but you cannot take that as a norm that this is what will happen. And for that to happen, then there are different tactical opportunities or
Okay.
options which are available. But risk will come with that. So
Yeah.
that is again very important. And the third parameter is, I think the investors need to understand one thing and keep this in mind, that you are coming in a mutual fund product, right? So there are pool of investors who are coming for a common goal. Now it's which is now being handled by an experienced fund manager, and he's going to decide where he's going to invest, not invest. I think that's very important for
True.
investors to also keep in mind that while the products have buckets, within the buckets, what is the selection and what is the risk framework? Sometimes it can vary. I think that they need to keep in mind and keep checking the portfolios. And very importantly, we have these riskometers which tell you what is the risk element of the product,
Yeah.
or the category of the product versus its benchmarks. And it also now also gives you another table which is potential risk class, which
Hmm.
tells you on the even on the risk parameter, where do you stand. So I think these are two fantastic instruments to let you know that what is the risk after you've invested. So one is the category risk, which will tell you
Correct.
that before investing, what is the risk you will carry, and post investing, what is the category risk of the product itself. So I think these are some things that investors must keep in mind before they decide which category where to invest.
Perfect. I think that's a perfect parameter checklist, Srinivas, for any investor to, lay out their pros and cons and also try and understand when they're entering the market and what their horizon for that particular instrument is. Let's move from debt funds to long duration funds, right? This is also something that we hear from a lot of investors, amateur and experts both. Usually, LDFs or long duration funds are given to somebody or advised to somebody who's looking to diversify their portfolio. Is that correct as far as my understanding is concerned? What is the kind of investor who should be looking at long duration funds if he or she is looking to diversify their portfolio?
Yes, so if you look at the long duration funds, there I think within that there are three important aspects that one should first talk about before we go into the execution part.
Sure.
First of all, is how does the debt fund itself sort of create extra returns? I think that
Okay.
that's also very important. Is because principally investors, when they look at say a time deposit or a certain maturity sort of a product, they would invest, and after that time period they would get a return of that, right? The same concept applies in the debt funds also, right? The fund managers will invest on your behalf. They will decide that here is a 5-year duration bond, there is a 3-year duration bond, or there's a 1-year duration bond, and they will deploy certain funds percentages as per. Now comes the time when you have a interest rate outlook, right? So there is one duration outlook and there's an interest rate outlook. So if your interest rate outlook is that investors, the current interest rate regime that you are in, uh, would sort of move downwards. So if you're expecting an interest rate cut, or you're expecting an interest rate upward revision.
Yeah.
So if you're expecting an interest rate cut, then the day the cut will happen, and if you have a 5-year sort of a bond with you,
Sure.
at say 7%, I'm just giving a example, at
Yeah.
7, and because it's 5 years, and there is a interest rate cut by say 1%, then you have to do multiplication, which is 1%. So what will happen suddenly is in the market, that 5-year duration product of 7% becomes more lucrative because now the other bonds which are available at a lesser percentage.
Correct.
So it
Yeah.
also happens when you do a time deposit, right?
Hmm.
That currently you invested for a 3-year product where there was X percentage, and later on, after 6 months, again you want to do a 3-year investment, and maybe
Hmm.
the percentage is X minus 20%, right? In a way. So why that has happened and why suddenly the first one becomes more lucrative is because you have invested in something which is going to give you more.
Yeah.
The same concept applies here also, but with an added layer that the fund managers will also keep looking at the situation
Hmm.
and keep looking at better opportunities. And if they find a better price for that bond, they could also trade for it. And when you trade
Okay.
for it, there is a capital appreciation that you will receive, right? And that goes back to your fund NAV, and that's why your returns could also temporarily sort of move up, right?
Sure.
Now that generally happens when your duration of the product is longer, and that is why the benefit will come in long duration. The flip side of it is if the interest rate say moves up by 1%, then the reverse comes into picture, where temporarily you would find a fall in your value of
Yeah.
NAV. So the risk of these products and long duration funds is that you could come into a product which
Hmm.
could give you higher appreciation, but at the same point of time, it could give you higher notional loss also. And that is something which investors should keep in mind, right? Because these trades will keep happening because
Yeah.
that is the whole purpose of it. Now, why one should look at long? Your second part of your question was why should
Yeah.
one look at a long duration fund? Now, if you look at uh, the economic trajectory of
Yeah.
the country, then all developed nations would have gone through a cycle where earlier your interest rates were very high, and then they start keep up coming down because your when your economy is of smaller size, the inflationary pressures are also high.
Hmm.
So there was a time when my dad used to do investments, and it was a double-digit interest rates,
Hmm.
right? Sometimes mid-teens they would have received.
Hmm.
Now that today is not possible because
Yeah.
your economic cycle is in a different geography.
Yeah.
Today, when we compare with say developed markets, their interest rates are much lower. Their inflation
Yeah.
sometimes can shoot up, but in conjunction to the interest rates, they work in that time. Because we are an emerging economy on the path to developed, we've already seen our interest rates come down since 2016, and temporarily because artificially during COVID they went up because
Correct.
it
Yeah.
curb inflation. And today again we are at a cusp where maybe in some point of time you could look at interest rate changes.
Hmm.
But on a long-term trajectory, you will find that the interest rate regimes will come down, inflation will come down as the
Yeah.
size of the economy grows. Now, investors need to keep that in mind that
Okay.
while there was a time when equity markets also delivered much higher returns, the
Yeah.
long-term averages have been falling from 15 to 14 to maybe now 12, right? Same way, interest rates will also sort of keep coming down over a period of time. Momentarily, they'll go up, but when
So,
you take 10-year,
Srinivas, I'm just interrupting you because I just want to understand this. And this is, it's good that you're giving this example with also the climate that an investor is getting in, right? If you look at the commentary that is coming from the central bank or even from the MPC meetings, as you pointed out, maybe in a while from now, in a few years, in a couple of months from now, we would see some sort of correction and maybe some sort of leeway or space for a rate cut. But if you just go back to the last MPC, right, where you just saw a change of stance, which was also read into well as far as where the commentary is headed. In that market scenario, in that climate, is an investor looking into diversifying their portfolio for LDF? Is that a healthy climate?
Yeah, so we will probably stay away from giving a view on
Sure.
this because it's very important for an investor to first understand how the product concept works and then decide whether he wants to sort of, take exposure to this. Because like I said, the risk element and risk reward here is pretty high as compared to
Hmm.
maybe a shorter duration product or even, a money market product or a cash management product.
Okay.
Um, so what I was saying is when you look at long-term trajectory of economic cycle, everything fits in. Your equity returns will also fit in. Your debt return cycles will also fit in. Uh, Now, given that where we stand today, uh, investors can take in view that if you look at what happened with the other developed markets, where how their interest rates change when they became trillions of economy and started to become 10 trillion, 12 trillion, 13 trillion, what has been the change in interest rates?
Okay.
And the similar thing, if you start looking here, then you would start as like taking notice that yes, if you compare 10 years back or maybe even 2005 or maybe even 1995, if you take a 30-year period, your interest rates move in certain bands.
Okay.
And but always if you start taking decade by decade, you will see a declining thing. So maybe we are also headed in the same way as our economy will grow. Now, what does that mean? Does it mean that he is going to get lesser return? I would say that you have to look at it relatively. Everything in investing is relative,
Sure.
relative to what time period you are in and what you are in, right? So if your interest rates come down, which would mean that your inflations are lower, which means when I showed you the maths of equity, that inflation plus GDP plus corporate,
Correct.
it
Correct.
means
Hmm.
that band also starts lowering. So
Hmm.
overall, everything starts lowering,
Okay.
right? But if your inflation keeps going up, interest rates go up, then everything again starts moving up, right? Now, what is healthy for you, for your portfolio, for your risk-taking appetite? I think that is something for each investor to look at its own
Sure.
portfolio, where they already stand. That is also very important. Are you too much tilted towards one side,
Okay.
right? Because balance is the most important aspect.
Yeah.
See, asset allocation will drive 92% of the return. Timing only drives maybe 3-4%.
Correct.
Correct. So whether you are taking one asset class or second asset class,
Correct.
this is very important. And
Correct.
why say LDF today makes sense for an investor to have that as part of the portfolio?
Hmm.
If you are looking at long-term growth potential of the economy, then you are taking exposure to equity and probably you're going to the highest risk element,
Okay.
right? To give you the maximum return.
Sure.
Because you're taking a long call. Maybe you're saying that India will grow in next 10 years, so you're investing in probably equities taking a 10-year horizon. Similarly, if whatever I said is if inflation come down, interest rate come down,
Sure.
then naturally your tendency should be that you should also have a long debt exposure,
Hmm.
right? Because if interest rates come down, that's where your maximum sort of opportunity lies.
Opportunity is there. Yeah.
But again, the risk element of that is there that if it doesn't come through for some
Correct.
time, or it is delayed, or it
Hmm.
doesn't match your time period.
Yeah.
See, the other mistake what most investors do is they would try to time this, and I think that
Okay.
is where a lot of hurt happens. That look, here is an opportunity, let me invest, and say this those things do not turn out the way they are.
Yeah.
Unlike the horizon of the like a long duration fund, the minimum duration would be at least 7 years.
Yeah.
Now, if you don't want to wait for 7 years, and if probably you wanted to invest only for 3 years and you invested in
Yeah.
this product, then if it flips, then I think the hurt is higher.
Okay.
And that's what investors should remember.
Yeah. Yeah, I think that's very well put, Srinivas. As you rightly said, that you cannot have a tilting towards one side as well. Balance actually is that big key, and that decision will have to be made also on an individualistic level, looking at the time of you entering, the time of you diversifying your portfolio, and what your time range and what your horizon is. Before I just move forward, there are certain terms that are often associated with LDS, which a lot of people who might be looking at LDF for the first time might not know. One of them, of course, is the macular duration, right? And as you said, that there is, of course, a 7 year. But I just want to go back a little bit. If you could help our viewers or whoever is, watching us right now to try and understand what the macular duration is, and then, of course, we'll try and understand what is that minimum duration that needs to be maintained for an LDF as well.
Yes, so I think if you have to go in the technical formula of it, then probably that will be too much
No,
for
just simply for people to understand why that duration becomes so important.
right, right. Let me explain duration first with another example, right?
Sure.
Um, uh, do you know why the train wheels do not sort of fall off from the tracks? The trains run on a very high speed, right?
Yeah.
Right? But even if there is a curve which is happening or it's running straight, especially on a curve,
Yeah.
you will find that there may be some accident which happened due to derailment,
Sure.
but though that percentage to the number of trains running is very low,
Yeah.
right? Why don't they fall off?
Is it because the foundation is strong?
Uh, yeah, part answer, but it's because of the way the wheel sets are made.
Okay.
It is in a concave sort of a set. The ones
Yeah.
they are not straight. They are little
Hmm.
sort of cone structure, small ones, and the weight is balanced between it.
Hmm.
So when it's turning or there is sort of things, the train balances it out, and that's why they don't derail. Now, duration strategy actually is something like that,
Okay.
okay, where you will have bunch of elements,
Yeah.
bunch of portfolios. The portfolio will have certain bonds at certain maturities, maybe a 20-year bond or a 10-year bond or a 15-year bond, 3-year bond, 2-year bond, and all of them when they match together, they will form a balance that you will have a shorter maturity, you will have a longer maturity, and the product sort of the train works in that way. So the
Okay.
product works in that way. Now, this balance is what is average duration of the product, right? And that helps you understand that what will be my average maturity. And while the LDFs or the long duration funds have to maintain a minimum of 7 years,
Okay.
you can go higher.
Okay.
So you could have a combination of a 30-year and say a 5 year, a 20-year and a 3 year.
Sure.
And depending on how much percentage allocation is to all of them, that average should come above 7.
Okay.
So if an investor doesn't want to take an exposure which is 7 or beyond, then I don't think this category is suitable.
Works with them. Yeah.
Then they should look a medium duration, which is between 4 to 7, or those
Hmm.
start a shorter duration, which is about 1 to 3, or lesser than that. And that's how you sort of.
The other aspect, of course, is when that investor is choosing an LDF, can that actually become the core portfolio as far as an investor is concerned? Just LDFs itself? Can that be seen as a core portfolio?
Um, so it can, but then again, I would like what I explained right now of maintaining that balance.
Balance. Hmm.
So in say on the equity side, you are doing large caps, mid caps, small caps, maybe
Okay.
some,
Hmm.
and you're diversifying your portfolio. Same way, you need to also do it on the debt side. That not everything can be at the highest maturity. Not everything can be at the lowest maturity. If you have sort of bunching of those, then you will have something which is an average again. So you're
Sure.
spreading your risks. Can this be a core product? I think if you understand the risk associated with it, Today, if investors choose, say, a large cap or a flexi cap as one of the most important or a core of the product, it's because you feel that these companies, which are generally the top 100 companies where it is getting invested, are the quality companies here. Similarly, if you come to, say, long duration product, then what we are playing is not with, of course, the quality of the portfolio is there to be for people
Sure.
to check, but you're playing with the time horizon, right? So if you're again not suited with that time, then you may sort of say that, okay, this was something which was very aggressive for me.
Hmm.
Maybe I should have invested in something else. But keeping in mind that how we are sort of moving ahead in the economic journey, I
Yeah.
think this is one category which investors should look on its merit. Of course, do read the risk parameters is most important, and there are always, the mutual fund distributors and the
Correct.
SEBI-registered investment advisors who can help you understand that whether this product is good for you.
Right. Srinivas, because, we're running out of time, I just want to quickly understand the other end of the spectrum. Through the course of the conversation, I asked you what are the factors that the investors should look at while they're either getting into debt fund or LDS. I quickly also want to understand three top mistakes that you would have seen investors making while choosing LDFs or while looking at LDFs. Are there three mistakes that they should completely avoid?
Yeah, I think one is, just falling for timing. You
Hmm.
should not. Just because there is an opportunity, but you may not be ready for that volatility which will come with that. So that is definitely a mistake one should avoid, and that
Okay.
needs a lot of more understanding. There is a lot of material which is available on the websites of the AMCs. You can go and read about what it means. Also on Amphi, there are a lot of material available. So, what is the product? How does it sort of operate? I think that is very important for
Sure.
one to sort of understand and avoid that mistake. Second, I would be like expecting this product to give you equity like returns. I think that's something which you should avoid. That
Okay.
because just because I'm going long on duration, it will generate me that sort of an alpha, which maybe equity markets do deliver in certain time periods, which
Hmm.
is beyond anybody's control because you don't know what will happen.
Yeah.
So comparing it with that is again sort of something which a mistake that one can avoid. And the third, I think, is also sort of venturing in and then venturing out very quickly,
Yeah.
right? I think that is something which investors should remember, that not everything you will have to give time for investments.
Correct.
Otherwise, you have the overnight funds, the cash management funds, which will give you 1 day liquidity products or 7 day liquidity
Yeah.
products, right? And they give you coupon according to that. I think then you rather go there. But if you are trying to sort of get in something with a vision, you've understood this, and now you're going to give it, especially for this category.
Yeah.
There will always be a cycle,
Yeah.
and every few years that cycle will repeat.
Correct. Hmm.
So if you sort of become a early cycle investor or a mid cycle investor or a late cycle investor, then your experiences are different.
Okay.
But you need to do a complete cycle to understand how does this work.
Okay.
And that is again very essential, that if you just step in and step out saying that this is not for me or
Not
this
for
is
me.
for me, and then you keep wavering between those two, I think
Yeah.
that again is not sort of healthy. So
Yeah.
what finally what I'll say on this is, I think we have seen key change in behavior on the equity side, with investors coming in periodically, regularly through SIPs, investing, contributing. They have understood the volatility, the risk aspect of it. Here, if they apply the same principles, if they research more, if they understand what is the risk associated, the volatility of this, and how over a period of time it gets evened out the way it does on the equity side, I think they would understand debt investing far more easier. It will become easier for them.
Perfect. So I think the big takeaways, Srinivas, whether it was debt fund or LDF, was that you need to do your own research. You need to understand what your risk appetite is. You also need to look at the climate and when you're entering the market, and you need to have that clarity. As you said, you can't be having your feet in both boats and then trying to jump and then wondering why are the returns not coming. But Srinivas, unfortunately, we've completely run out of time, so I will have to wrap it there. But thank you so much for helping us understand this fascinating world of debt funds as well as LDFs, and also for investors to get an insight into it, whether it works for them and whether this should be the way to diversify their portfolio. So thank you once again for taking out the time and joining us.
Thank you, Ridhima. Thank you so much for having me today.
So we really hope that this was insightful for all our viewers as well. If you have any queries, we'd love to hear from you. We'll have to love to hear your thoughts as well. And that's a wrap from us, but we'll see you next time. Thanks a lot for watching.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.